You're listening to AI PRISM from Seoul Economic Daily.
It's Tuesday, May 19. I'd like to share some thoughts about retail investors. Imagine an economy where luxury goods are just flying off the shelves, but at the very same time, thousands of people are downloading a beggar map just to find a cheap lunch.
Yeah, it's a huge paradox in the South Korean market right now.
Right, and if your portfolio has any exposure to this region, we really need to do a deep dive into how, a storm brewing in the bond market is colliding with extreme stock volatility.
And a very fractured consumer base, which completely alters your risk profile.
So let's start with the anchor here, the government bond market.
Right, so the 10-year government bond, or Gukchai, it actually just hit a yield of 4.239%.
Wait, so it's up, 0.853 percentage points since January?
Yeah, exactly. I mean, that's the largest year-to-date rise globally. It's easily outpacing both the U.S. and Japan.
Wait, I want to pause there because that feels kind of counterintuitive. We just saw a strong first quarter GDP growth, right? 1.7%. So shouldn't a strong growing economy mean a steady, predictable bond market?
Normally, yeah. But strong GDP growth signals to the central bank that the economy is running hot. So they will likely keep interest rates higher for longer to fight off inflation.
So the bond market is just pricing that reality in.
Exactly. And then you combine that with this massive issuance of 2026 deficit bonds. I mean, we're talking 110 trillion won.
Which is about $79 billion US dollars.
Yeah, $79 billion.
Yeah.
That flood of government supply just causes a massive spike in yields.
So to translate this to equity risk for you, the listener, especially if you hold the EWI ETF to get that broad South Korean large and mid-cap exposure, I kind of think of bond yields as a gravity well.
Oh, that's a really good analogy.
Right. Think of bond yields as a guaranteed paycheck, while stocks are a commission-only job. When the guaranteed paycheck suddenly gets a massive raise, up to 4.2%, investors just start asking themselves why they are taking the risk of working for commission.
Yeah, the guaranteed paycheck looks way too attractive. The real danger for those ETF investors is a potential buyer's strike.
A buyer's strike?
Yeah. I mean, if bond buyers step back because they expect yields to climb even higher, it just sucks capital away from riskier assets. That compresses equity valuations across the board, creating a heavy headwind for anyone relying on those large-cap Korean stocks.
And we are definitely already seeing that capital pressure play out violently. The KOSPI, the benchmark index, it touched a historic 8,000 and then just crashed right back down towards 7,500 in the exact same session.
It's wild. I mean, the historic undervaluation of these stocks, what everyone calls the Korea discount, is rapidly eroding.
Because of the massive semiconductor supercycle, right?
Exactly. Tech profits are rocketing the index upward, but the volatility is just terrifying. They actually had to trip the sidecar circuit breakers 2 days in a row.
Wait, a sidecar, that's the automatic trading halt when there's a 5% swing in a single minute, right?
Yes, exactly. It stops futures from free falling. That's how extreme the swings are right now.
Okay, but let me push back a bit on how risky this actually is. Samsung Electronics and SK Hynix, they make up 48% of the entire KOSPI.
Right, they do.
That is a massive concentration, but they are also printing money right now. Doesn't that profit justify the heavy weighting? Kind of like TSMC over in Taiwan.
Well, sure. The earnings absolutely justify the current numbers, but extreme concentration creates extreme structural vulnerability.
Oh, wow.
Yeah, when two companies make up half the index, their individual stock swings become your ETF's systemic risk. And analysts are actually flashing a major warning signal right now.
What's the warning?
If SK Hynix overtakes Samsung in a market cap, the resulting momentum chasing could end up mirroring the year 2000 U.S. tech bubble.
So we've got these top-heavy tech giants driving the market, but then on the ground, the actual humans living in this economy are painting a very different picture. It's a brutal K-shaped reality.
Yeah, the disconnect is jarring.
It is. Asset owners are driving up luxury spending, but wage earners are relying on that viral Juji map, the beggar map, just to locate ultra-cheap meals to survive.
The retail data totally backs this up, too. Daiso, which is basically the equivalent of Dollar Tree in Korea, they just saw a 30% jump in cosmetic sales.
Wow, 30%.
Yeah, and at the exact same time, Emart Traders, which is a massive discount warehouse chain, they hit over 1 trillion won in first quarter revenue.
Which translates to about 714 million US dollars.
Right. So this severe consumer bifurcation, it really completely undermines the narrative that Korea is experiencing a broad, clean economic recovery.
It really feels like a powder keg. You have a squeezed middle-class, wildly volatile tech stocks carrying the entire index and climbing bond yields pulling capital out of the market.
Which brings us to one final, very provocative risk factor you need to weigh. As you assess your portfolio's exposure, you really need to watch the foundations of those major tech companies. There is an impending Samsung general strike set for May 21.
Wait, a general strike?
Yes. If that results in a major production halt, the fallout wouldn't just stay inside the company walls.
Right.
It could be the exact downside catalyst that sends both the KOSPI and the EWY completely tumbling.
That's today's AI PRISM, Retail Investors. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a Juan Ifro award-winning series. We'll be back tomorrow.
You've been listening to AI PRISM from Seoul Economic Daily.